Record. All right. So, little bit different this morning, guys. I do not have a PowerPoint presentation for you. I know you're upset by that, because I know everybody loves the graphic skills that I have. But which if you know me, there are no graphic skills whatsoever. So today I'm not going to bore you with that. We're going to jump straight to the charts here in a minute, but we're going to go through CFAP. We're going to go through the WASDs again, because I think it's really important that we wrap our heads around how those WASDs reports can be adjusted and what that might mean to price, and then we're going to jump into charts. All right, so this is the actual CFAP report that is published. As a lot of you know, what they taught us in law school is don't think great thoughts, read the statute. So this morning I went through and read every word of this stupid thing, and it comes down to 2 paragraphs on page 30 that matter. Right here, it's this simple. Unpriced inventory. Everybody's reading this, and there's lots of different interpretations. I'm reading that it's on that you get paid on half of your bushels from last year. I'm reading different things. Here's what the rule says. The rule says that you will receive payments, and non-specialty crop, corn and soybeans are included in this. So you can just assume that that means corn and soybeans. You will receive payments on unpriced inventory that is held in inventory as of January 15th. There is a little bit of ambiguity here as to if you had delivered to your end user but had not yet priced the bushels on January 15th, whether or not you are excluded on those bushels or not. I don't know that answer. I don't know how the agency is going to interpret that. But for unpriced inventory as of January 15th, you'll take that by really 25%, 50% times 50%, and you're going to do that off of the CARES Act and off of the CCC Act. So really the best way to think about this is that if you look at the CCC payment and the CARES Act payment and average them, you're going to get that price on half of what you had not delivered, and that's going to be your payment. So this really is a disservice and punishes anybody that did forward contracting and that was active and proactive in managing their cash price risk all year long. It's appalling what that the government did that to people, but they're the government. It's what they do. They appall people. So I guess that's as simple as I can make it. I know that there's going to be more questions, and if you have a good FSA agent in the next few days and weeks, I'm sure they'll have more answers, especially on this question. Unpriced inventory, harvested but held in inventory. Does it have to be on the farm, or do those bushels you've delivered and not yet priced qualify anyway? Because you still had the same downside risk, whether it was in inventory or whether it was on the farm. I think that'll be an interesting thing to look through. All right, let's turn to our WASD report, because we want to look at this a little bit and really wrap our heads around what's going to happen. So if you're paying attention to what the hedge funds are doing, and you're tracking the open interest, and you're looking at what the positions that the funds are holding, and these are these big speculative investors, right? And it's important to know what they're doing, because they're the aggressive traders. They're the ones that jump into the market and push the market one direction or the other, right? So if they're bullish one commodity and bearish the other, they will just buy at the market and push it. By contrast, a commercial elevator or a commercial manager, they're more patient. They're going to sit back and just kind of let the market come to them. They're trying to make money on carries. They're not speculating in the market. so they're by definition more patient. So when we look at the commitments of traders, what we've seen in the past few weeks is traders start to build a bullish position in soybeans and continue to sell corn. So as of last Friday, they were the speculative crowd was long about 30,000 contracts of soybeans and short 220,000 contracts of corn. And if you watched the trade closely yesterday, you could see this in action. As corn would rally, they would sell beans. So they were unwinding those positions just a little bit. So what is it about beans that they're interested in? And let's kind of walk through it. So this is the neutral case. This is exactly what the USDA told us the new crop was going to look like in their May report, okay? These numbers are just reprinted right here. Very simple. And they're telling us that we have a 405 million bushel carryout in soybeans. What that does is that equates out to a 9.39% stocks to usage. That's 405 divided by usage, right? So now how does that look in context of prior years? If you pull up the charts that show this historically, 9.39% is much tighter than we were a year ago, because a year ago we were almost at 23%. So it's much, much tighter. So you would think that that would relate to higher prices, but that's not necessarily true, because, and this has been confusing people, because if your stocks to use drops by as much as it has, then why aren't we rallying? Well, it's because this is still a really big number. And 9.39% historically is not viewed as tight on a stocks to use ratio for soybeans. And it's even less so this year because Brazil has so many of them and they've gotten so much better at growing. So 939 is relative to what it's done in the past. But I think this is what the funds are looking at. Last year, our yield on soybeans was 48, or just a pinch over 48. And this year, the USDA is already using an all-time high yield of 49.8 in their projections. So if we get any kind of a weather hiccup at all, you can see a dramatic shift. So let's say we lose 43 bushel, 3.8 an acre, and drop it to 46. And let's assume that we plant more beans than what the USDA has been saying, okay? If those things become true, then our carryout drops radically. So here we have a situation where soybeans have a very, very high sensitivity to yield, which implies weather risk. So the funds are building a long position going into the summer just in case this happens. Because it's all a function of risk, right? If you look at a 405 million bushel carryout and a stocks to use of 939, then beans could be valued anywhere from 8 to 850, which is exactly where we're trading. So the downside risk in beans they view as limited, while the upside potential is much, much greater. So now you have your risk reward set up. So you're seeing the funds build this long position because of that dynamic. Now take a look at corn. Corn stocks to use is much, much higher. Let me put that in here. It's this divided by this. Corn stocks to use, right? We're sitting at 22.4%. And we did this math for y'all last week. A 22.4% stocks to use is very, very burdensome for corn, and historically would show corn much lower than where it is. And you have to have some pretty significant changes to really make a dent. So for corn, even if you lose 4 million acres and you have a yield problem over the summer, you end up with a stocks to use that really only drops to 13. So anything over 10 really isn't all that bullish for corn. So the story's just not there yet for corn to really pick up and rally. So that's why you're seeing the funds have an interest in beans and not in corn. So let's look at what that looks like on the charts. All right, let's start with wheat real quick and just get it out of the way. I ran out of time last week and we didn't talk about it. So wheat busted out of its range. It's now finding support down here at this level. So it looks like wheat is kind of range bound from $4.20 to $5. We just probably are going to bang around in here for a while until we get some indication to push us out of that range. It's dry in the crop is not great in Europe. The crop is not that great here in the States. We have very low acres, and we're getting to the time of year where wheat tends to start to rally a little bit. So don't be surprised if wheat doesn't bounce pretty significantly from here. If it fails and retests today's low, then yes, we should come down and test the 427 level and potentially even the contract low back here at 419 if it fails. So not a whole lot to do on wheat. You just kind of got to wait for the next real signal to happen. All right, here's beans. So remember, during this time period, from April 1st through here, as we've just drifted sideways in soybeans, the funds have built a medium-sized long position based on the fundamentals that we just kind of went through, right? So if you build a trend line, let's put a trend line on here off of this low through here. Soybeans are finding some support. So we have a little upward lean to this period. Remember, what does an uptrend look like? Higher highs and higher lows. So you have higher lows, and here you do actually have higher highs, even though we can't seem to hold a rally. If beans can continue to find a little bit of support this morning, then given the setup that we just went through, beans could get pretty hot and could come test this $9 level very, very quickly. This would be the first level of major overhead resistance, which is at 907. But everything about this setup looks like beans could move higher. What could change that? Well, any number of things, right? The dollar continuing to rally and making us less competitive than Brazil. Washington can screw up about anything today, so a tweet, an escalation in the trade war, any of those things could cause funds to exit their positions and send this thing much lower. So we're back to weather in Washington, but if things hold and don't deteriorate, then it looks like beans should put some weather premium into this market just to compensate for that potential risk moving forward. Now, maybe it doesn't happen to have yet. Remember, your key weather month for beans is August. So between now and August, that's when these moves could happen. A carry out of less than 5% is significantly above above this blue line. Carry out of 9% doesn't necessarily have to. So somewhere in the middle, somewhere from $9 to $9.50 is a legitimate target for beans. All right, corn. As we went through on corn, the story just isn't there. You know, you're starting to read, you got some outlets that are trying to generate some bullish buzz on corn by saying, oh, it's wet. Well, yeah, it's wet, but not in the places that matter. The places that matter are planted. You've got 90% plus planting rates in Iowa, Illinois, Indiana. You just don't have the weather catalyst that we had last year. And given our experience last year, it's going to take a lot more weather situation to develop. So corn could rally here just because it's been oversold so long. We've been talking about this for a while. This is the time of year. The seasonality would indicate that we should get some upward momentum through June. And then once we pollinate the crop and confirm that it's been planted and confirm where we're at, that we could then turn around and start to work lower. So the fundamentals don't support a rally, but that doesn't mean it cannot happen. So can we get all the way up to 380? My bias is no. That doesn't make any sense. This is the Fibonacci 38.2 to 62% retracement of the of this move. So anything up into this area during the next 4 to 6 weeks, this would be your sell zone. And my opinion would be this would be a great opportunity to price an awful lot of new crop production, and you can always buy calls on it if you're worried about the upside. What would change the opinion would be a forecast and a 2012 type drought that could really truly meaningfully reduce that carryout and pull that stocks to usage number below 10. You know, if that were to materialize, then we can talk about a bullish story. But until then, I think you got to look at this, any rally that we get here, as a seller's opportunity, which is why we like these accumulators so much that we've been talking about. So here's your D-scorn, right? Here's the same kind of levels and values. This would be 360 to 370. That accumulator that we talked about last week, you can price every day that December corn is above 320, you can price at 360. So just think about that yesterday. If you'd had bushels in it yesterday, you would be pricing them at $3.60. So that's right in our upper band range, right? So that's a very prudent sale to make, and you can do that with no margin exposure, no real risk, and then we can wrap a put below it, so that if the price does deteriorate and we fall to 220, you're protected at $3 or even 310. So to me that's a very prudent move to make, because if the stocks to usage is as burdensome as the USDA says it is, then we may not hit that target, right? In order to get here, I think we got to get some sort of a story. Definitely to get above it, we got to get something going that's going to change it. Because right now, the bullish story is hope for a drought and hope that we shifted acres. But the prices don't really support that the acres shifted. I mean, if we're looking at the corn soybean spread, it's really not so in favor of soybeans that people are going to be switching left and right, especially not with our history of rewarding corn practices that probably aren't the best, right? We give you more payments when you plant it. We encourage it. Your crop insurance rate is good. So I think the corn crop is getting planted. So without trying to be too confusing, if we get a rally and it can get up to this 360 to 370 zone, my advice would be to sell the hell out of it, because if we work higher, great, we can find other ways to manage it. But this would be a gift at this point, given that setup. And if you can take this price today without having to take any risk or wait for a rally, then why wouldn't we do some of that through some of those accumulators? So that is all I have for you today. And I hope that challenges your thinking just a little bit. And if you have questions or want to talk more about it, please don't hesitate to give me a call. And we will talk to you next week.